My dad did pass away. I was a young boy, 10 years old. I had to grow up very quickly. I had to be like the navigator in the car and go through the mail. And I had to understand how serious life is at an early age. I know what it's like to be really, really poor. And I have been obsessed with doing the best I can to help others see that there is opportunity out there that they can capitalize on.
You come across as a very humble person and very knowledgeable at the same time. And this is what gives you that special insight. And everybody's rushing one way. You've got that foresight to see these things.
When the Fed oftentimes makes the error of being solely dependent on data, that data is old, months old, which is why the Fed, again, causes these boom bust cycles. And they kept interest rates way too low for too long, but they poured gasoline on that fire.
You bring psychology of the markets into your analysis, which nobody else really does. Why do you think that the Fed is making trillion-dollar decisions on old data? I'm assuming you're referring to the OER and shelter inflation lags.
Owner's equivalent rent is one of quite a few flawed measurements. While it says 4%, the real number is below 2. Insurance is another area because it is an emergency situation almost. It would be in figuring out a way to ease the burden on insurance. If government could do that, then make homes much more affordable in a very rapid fashion. You've hit on something that's brilliant. I've kept a really positive mindset. I've worked throughout chemo, several surgeries that it didn't work. I want to get the most out of every day. And however many days God gives me, I want to try and be positive and enjoy them.
The next 10 years will be the greatest opportunity of our lifetime for people who
are optimistic. And if you have gratitude, everyone you come into contact with, try and make them feel smarter and better.
Barry, you're now on the Fannie Mae board during the biggest FHFA shakeup in decades. What's the one structural change, LLPA, capital rules, or GSE mission alignment that could truly transform affordability?
Well, they're all important. I think that if the homeowner receives a little bit of relief in any of those areas, they could be beneficial. But the real thing that's going to transform affordability, the real big levers, there's three of them that people talk about. One is prices come down. That would be horrific. That would be terrible. Most people have never lived through that. So prices decline. People don't want to purchase homes. It becomes much more difficult to buy a home. Mortgage underwriting guidelines become very stringent. So that would be the worst of all scenarios. And let's remember that 2/3 of the country own their homes. That would be bad news for them, less equity, worse for their retirement, worse for their move up. And in addition to that, less money that they could pull out for things like debt consolidation or investment. So that's the worst one. The other is interest rates decline. Now that's the big one. That is the one that obviously we've seen that before. We know what happens when interest rates decline. You see a real estate market that perks up rather dramatically. And even times where we've seen interest rates improve, you're starting to see an increase in activity. A lot of people make the mistake. They say, well, so interest rates decline and we didn't see the bump up. It's different. A refinance, you'll see the bump up, and we have. But on a purchase, think about the psychology. It's like, guess what? We see interest rates have declined a little bit. Oh, that's nice. Maybe next weekend we can start looking at homes. Maybe the weekend after. So by the time they go out, they go shopping for a few weekends. Maybe they find something. Now they negotiate something. Now it goes back and forth. Will it get accepted? So by the time it shows up in data that we could see, like mortgage applications, or even much later, in closed transactions, it takes time for these things to occur. So you need the lowering of interest rates to be sustainable. I think we will get below 6%, but around 6% or so, if it's sustained, you should start to see a pickup. It's not going to be crazy. Now, as I said, there's three. The third is time. And the reason why time is so important is because incomes do rise over time. And people make a mistake and they say, well, if your income goes up 5%, but the home price goes up 5%, you're never going to catch up. That's actually not true because you don't use 100% of your income to purchase that home. You use, let's say, 30%. Average is about 20%, believe it or not. I know it sounds crazy, but those are the facts from Fannie and Freddie. But let's say it's 30% or a third of your income. So if your income is going up at 5% a year, well, it's equivalent to real estate prices going up significantly more than that because you don't borrow 100% of the purchase price and you're not using all of your income. So time will heal this or make it better on affordability, but who's patient for the time. So those are the three real important levers.
And when I look at your life journey, losing your father early, the immigrant experience and hardship you had to go through, do you think that created your obsession with understanding risk so deeply?
Boy, that's a great question. It is definitely formative. So my parents were immigrants, didn't even speak the language. It was very, very difficult. I was very poor. My mom literally worked in a sweatshop, which means, where they manufacture dresses. I remember going in there as a kid. And my parents were much older. My mom was 40. Today, that's not a big deal, really, but back then it was. And my dad was approaching 60, which even by today's standards, it's a little bit older to have a child. So my dad did pass away. I was, young boy, 10 years old. And this is something that definitely forms you, because I had to kind of grow up fast. My mom was extraordinarily intelligent, could speak 7 languages fluently. My dad could speak 10. However, my mom never got a formal education. Back in foreign countries, like my parents, my ancestry is from Spain, they lived in Turkey. And back then, women were not treated the same way they're treated here. So her mom got sick when she was a young girl. So they said, what does she need to go to school for? So my mom got pulled out of school in 3rd grade. So she never really got a formal education. So here I am, 10, 11 years old. I had to be like the navigator in the car and go through the mail and try and understand things. So I had to grow up very quickly. So I think that definitely was very formative, in that I had to understand how serious life is at an early age and learn things quickly, because I had to. The other thing is I was so poor, I think it fostered a lot of creativity, because I didn't have toys like everybody else. So I had to kind of invent stuff, And then the third thing is the obsession that you bring up. And yeah, I know what it's like to be really, really poor. And I have been obsessed with doing the best I can to help others to elevate themselves, to help others see that there is opportunity out there that they can capitalize on for them to create wealth, to create well-being. So those things have been an obsession for me, yes. And thank you for bringing that up.
You come across as a very humble person and very knowledgeable at the same time. And this is what makes you a very unique character and gives you that special, I would say, insight when you're standing on the sidelines and everybody's rushing one way, when the economy is collapsing or going to collapse. You've got that foresight to see these things, and it comes from a very special place, Barry. And I really respect that, by the way.
Thank you.
You're welcome.
Thank you.
And
it is, I don't mean to interrupt you there, but
go ahead.
It is something that we really try to do is understand that things are much more complicated than just the surface level. And you have to peel that back. You have to truly play chess instead of checkers and think several steps beyond. Many of us, we just read the headlines, including important figures like Fed members, and they'll just see like things like, okay, inflation is this, it should be that, but they're not digging deep enough to gather the understanding as to how do we look past this? What is the next step? Because it seems like they're looking backwards at data and not looking forwards. And that's what causes boom and bust cycles. Because when the Fed oftentimes makes the error of being solely dependent on data, that data is old, months old. Our economy changes and moves so rapidly. What you want to be is ahead of it, which is why the Fed again causes these boom bust cycles. And an example of which was that they were complicit in creating a lot of inflation in 2020, 2021, 2022. There was already money being pumped in, and they kept interest rates way too low for too long because they were looking at old data that suggested inflation was not problematic. However, if you look deeper, if you played chess, if you looked at some of the more changing indicators that don't yet show up in the data, could see that inflation was about to be terrible, but they literally was like putting gasoline on that fire. And now they are so foolish. And you hear some Fed members are clearly looking at things the way they should, but many of them saying, oh, the labor market's not a problem. And they're fixated on inflation, which is not really a problem, and whistling past the graveyard on the labor market, which really is a problem. And they are keeping interest rates too high for too long. So and the opposite error, but they're making the same type of mistake in being dependent on bad data. So on old data, excuse me. So when you ask me this question about being on the sidelines and watching things happen, I think what all of us need to do is we need to be sensitive to the fact that whether it's a human relationship, everybody's going through things. And somebody may present themselves in a certain way that maybe initially we like, "Oh, they're not so whatever. And I don't really appreciate that. Look, it's understandable. But I think we need to look past that and say, what's underneath that? What's causing that? Because look, we're all going through things, right? So we have to be understanding. And when it comes to opportunities in business, I think what we need to try to do our best to do to see the future before it becomes obvious.
I think that's what makes the way you read markets very special. You mentioned something about psychology, and you bring psychology of the markets into your analysis, which nobody else really does, or they think they do, but they don't really execute on that properly, or they're using old and broken data, as you mentioned. And why do you think the Fed is making trillion-dollar decisions on old data? I'm assuming you're referring to the OER and shelter inflation lag. Why hasn't that been corrected up to this point?
So you are 100% correct. And obviously, you're very well researched and knowledgeable. But yes, owner's equivalent rent is one of quite a few flawed measurements as to what is really going on with inflation. Owner's equivalent rent is simply a survey question to anyone who's a homeowner saying, literally, this is the question: how much could you rent your home for without furniture and without utilities every month? Who knows the answer to that question? I mean, really. And then to try and exactly determine the change from one month to the next, that's a Herculean task for a normal homeowner. And then there's self-bias, is that just like when you ask someone, hey, how much could you sell your home for? We all kind of think that we should be able to get more for our home sometimes than it's potentially worth. So how much can I rent it for? I might say more. So the fact is that as we speak today, that OER, owner's equivalent rent number, stands at 4% annual increase year over year. Now, this is very significant because it represents 33% of the core CPI that the Fed looks at, and 14% of the core PCE, which the Fed looks at even more closely. That's Consumer Price Index, personal consumption expenditures. These are the two main gauges of where inflation is and where it's going. So why is that so important that OER is correct? Because while it says 4%, the real number is below 2. And we know the real numbers because we have things like Apartment List and Cotality, and we have Zillow, Fannie Mae, several others that can tell you the change in rents year over year. So we have accurate data. And by the way that the methodology is that the Fed looks at, which is created from the BLS, Bureau of Labor Statistics, is the same that they've been using since 1985. Now, it's interesting because there was a report called the Boskin Report back in 1996, and even more recently, several reports that said the Fed's got to change its methodology. So, by the way, that's one. The other is they don't look at the tariffs being something that is not inflation. Tariffs are a one-time price adjustment. And then inflation is persistent every year. The difference is if you consider a staircase, right? Inflation is a staircase that just keeps going up. A tariff price adjustment is like a one-step staircase, and that's it. So the next year, year over year, it's no longer affected by the tariffs. The tariffs has a 1-year life expectancy, or for however many months, but on a year-over-year basis, it's got a 1-year life expectancy. So we should be able to, again, see into the future, play chess and not checkers, see beyond the tariffs and understand what else is going on. Now, there's a few other things that are crazy. One being the fact that they look at something called portfolio management fees, which should not be inflationary. And portfolio management fees, many of us may be familiar with it. If you have money with a mutual fund or with a broker, more or less, they're going to charge your assets a fee. Let's say it's 1%. Now, look, if that was going up from 1% to 2% to 3%, that's clearly inflationary because the percentage you're paying is greater. But if it stays at 1%, the BLS, unfortunately, considers it inflationary if the stock market's going up or if your assets are going up, because on a dollar basis, you're paying more. They should be looking at the percentage you pay, not the dollars you pay, because you're happy to pay those dollars. Heck, I'm getting 99% of that benefit. I'm happy to pay. I'm glad, right? I mean, think about it, how ridiculous that. And by the way, that accounts for an overstatement of 0.3%. The overstatement in owner's equivalent rent accounts for about 1% in CPI overstatement and about 3 to 4% in PCE. So these things are making inflation look worse than it is. The Fed members are getting the wrong idea on the fear of inflation, which there really should not be any. That's not to say people going to the supermarket don't feel the pinch. But the way we should look at inflation is we should look at inflation as there's a cumulative aspect and there is a inflationary aspect that happens year over year. Now, the only way to ease the pain of a cumulative aspect that we had for the past few years after COVID, based upon some of the decisions that were made at the time by the administration in place and the Fed that caused this inflation, that's cumulative. That doesn't go away. The fact that, an item at the grocery store that was $1 now costs $1.50, that's cumulative. That's not going to stop unless you force prices down. But there's severe consequences to try and do that. You hurt a lot of things along the way. You cut jobs. It could be really bad. And then there's the price increase from this level upwards. So the price increase from this level upwards has eased. They want it to go up 2%. The Fed they specifically say we don't want prices to go down because they realize how devastating deflation is. It's much worse than inflation because nobody wants to buy anything. Prices going down means that, hey, look, think about it this way. If something's going to be on sale next week, I want to buy a suit. And next week or 2 weeks later, they're going to put a sale on. I'm not going to buy it today if I can get a big discount, right? And then I go 2 weeks later and say, well, we're going to have another sale 2 weeks later. I am going to continue to put off purchases because prices continue to decline. It is devastating for any economy. That's been proven throughout history. So the Fed specifically, they don't want zero inflation. They don't want minus inflation. They don't want deflation. They want inflation. They know it's healthy. But now their measuring stick is wrong by telling them it's 2.9%. It's really about 2%. But yet they're unable to see into the beyond what is just in front of them. They're not able to see the forest because of the trees. So what we should be doing is we should be looking at these things and saying, hey, inflation is actually healthy. It's actually needed at a small level. And if it is slightly below or slightly above it, let's understand why it's that way. And let's understand more importantly, where is it headed and what's likely to push it in one way or another. So when we listen to Cleveland Fed President Beth Hammack, who I don't know if she's trying to campaign for something, but she goes on TV and says, I talked to my people at the Cleveland area. I was in Cincinnati. These people complain that the prices in the supermarket are too high. That's because of cumulative inflation. That's not because of the inflation that is occurring right now. And she just doesn't understand it and gets it. And, then she makes a comment like, they're complaining that instead of steaks, they're buying hamburgers. Well, you know what my response to that is? Well, if you would stop keeping interest rates too high, if you would help those customers out, those constituents out by reducing interest rates to where they should be, because you're smart enough to look past inflation, you're smart enough to see the pain in the labor market, maybe those people would not be losing their jobs, would not be laid off. Maybe those people could find a higher paying jobs, and maybe those people would have been able to save more money on credit cards, car loans, and on their mortgage or refinance it. So now instead of having burgers, they can indeed buy steaks. But the mentality of the Fed is not that way, unfortunately. Sorry for the long answer, but it required a longer explanation.
No, you gave a very good high-level overview and you drilled down into some of these areas. And I just want to follow up on that and say, if you were to give me a 24-month crystal ball mortgage, home price trajectory, and the one shock you believe is coming, then none of these people have actually priced in yet.
So shocks are hard to forecast. People talk about them as black swan events, the unpredictable stuff that you don't see. So by definition, it's kind of unpredictable, right? It hits you. So very hard to forecast those. But let's talk about what you asked. Interest rates and home values, real estate values. I think that's where we want to go. And I believe you said like a 24 months. So listen, let's remember, the further out you go, the foggier the crystal ball gets, right? But it appears to me like anything else, real estate values are going to be based on supply and demand. So what do we know we've had? We know that demand comes from something called household formations. And I know that you know this. So household formations is like, let's say mom, dad, and a child living in a household. At some point in time, the child gets their own place. It's still the same family, mom, dad, and a child, but instead of one household, they have two. They have formed a household. So that forming of a household creates demand. Now, what about supply? Supply doesn't come from somebody selling their home. It doesn't come from there because that person then goes to the demand equation. So they have to live someplace, right? So just like they're selling a home, so that's neutral for the most part. I mean, you may have some instances, but for the most part, neutral. And that's why it's so funny, because there's these talk of these portable mortgages and then people can move, and that would create demand because they would move. It would not create the difference in supply and demand that they're looking for. That's a neutral move. So they don't understand this. Again, checkers instead of chess. Supply comes from builders putting up homes. That's where it comes from. And what we've seen occur is that for about 5 years or so, our demand had averaged about 1.8 million households a year. Now, inventory was tight because builders were only building 1.6 to 1.7 million households a year. So as you could see, there was more demand than supply. Real estate values, like any other economic circumstance, would be rising, and they had been. But something interesting has occurred in 2025. Demand has shrunk rather significantly. Now, it is a volatile number. People are quick to change their mind. But I do not believe that the slowdown in demand is a fundamental change. People still want to get married. People still want to have kids. People still want the backyard. They might want the home office. They might want the garage. People still want these things in life, but they are not stopping it, but they're postponing it. So think about it this way. It's evident in the fact that a few years ago, the median age of a first-time home buyer was 33. It's gone to 38. Now it's 40 years old. So they're just waiting longer to do this. But they're not going to be 70 and living with mom and dad. Okay, so it's not going to happen. So they're going to finally get their own place. It's just taking a little longer to do so. So this will rise. It needs a catalyst. What is that catalyst? That catalyst is an interest rate environment that's lower, that's sustained, but also as time goes on, their incomes go up, bridging that gap a little bit more. Now, let's talk about supply. Remember, I told you builders were putting up 1.6 to 1.7 million homes per year. However, builders, seeing the drop in demand, have correctly reduced the output. They're saying, hey, why are we going to put up 1.7 million homes a year? They're going to sit. It's very expensive to do so. So they have cut that down to about 1.2 million homes a year. So they have correctly dropped the amount of supply to closely approximate demand. But here's the interesting point. Now, if we all put our thinking caps on, and if we all want to play checkers, if we all want to see the future, play chess instead of checkers, and if we all want to see the future before it becomes obvious, then think about where the opportunity is. See, if you believe like I do, for many different reasons, and we didn't talk about this yet, the interest rate component, that interest rates will decline. Well, if interest rates decline, what happens to demand? Demand spikes because that's what demand's been waiting for. But can builders quickly keep up with that demand? It's going to be hard to build a home in a week, or a month. This will take perhaps a couple of years to match the increase in demand. That couple of years, I think, creates a very good opportunity because if you do buy a home now, you're likely to see pretty reasonable price appreciation and wealth creation within that period. So we talked about the real estate portion, which is going to be dependent on interest rates. Now, interest rates, few reasons why I think interest rates will improve. The Fed funds rate is the mother's milk. It starts there. The Fed has to cut rates. The labor market's in trouble. Inflation is not the problem it is. So lower inflation helps long-term rates on its own. It also helps the Fed. So we see a dual benefit there. So we think that interest rates will be assisted by that. As the Fed cuts interest rates, the spread between the 10-year Treasury and 30-year fixed rate mortgages compresses. As that occurs, mortgage rates improve at a faster pace than the 10-year Treasury does, giving them an accelerant on the benefit of seeing a reduction. There are a couple of things that are important too. Beginning December, the Fed has already told us that they will end the runoff of their balance sheet. So we haven't seen the impact of that yet. That's additional buying of treasuries. And while it is treasuries, the overall debt market of treasuries and mortgages, when you start to absorb the supply that's out there, just like anything else, that demand increases, you start to see an overall improvement in interest rates. In addition to that, there are things that have occurred. The Genius Act, which now is something where stablecoins are being used. Well, stablecoins, you can't have stablecoins have any kind of a confidence level without it being backed by something. They're backed by short-term treasuries. Why is this important? Because as stablecoins grow, they will absorb more and more and more short-term treasuries. Now you might say, Barry, well, short-term treasuries, that's not the same as long-term treasuries. And you're right. But again, if we play chess instead of checkers, you think about somebody like our very smart Treasury Secretary, Scott Bessent, who now has control over which securities to issue. He could actually issue more shorter-term treasuries to pay our debt or to borrow against our debt, I should say, where the demand is there, keep sell less longer-term dated maturities, meaning they would be more as a premium because there's less supply to meet the demand. That would increase the price, but as price of a bond, like a 10-year treasury increases, the yield decreases. So that would help rates come down. And then there's a bank deregulation deal that hopefully will happen soon. What this means is that banks can purchase treasuries more easily. Why more easily? Because currently, if a bank purchases a treasury, they have to consider a portion of that treasury to be risky. So they have to withhold some capital against it. But what Scott Besson's saying is, why is there any risk? It's based upon the full faith and credit of the U.S. government. So if you now can purchase those treasuries without withholding capital, it increases the rate of return that you receive on those. The yield gets juiced up, so they become more attractive. If banks buy more, again, more demand for treasuries, yields come down. So that's why I think there's a lot of reasons to believe that we should be in for a favorable marketplace. So over the next year, do I see mortgage rates getting to 6, 5.75, maybe even a little less than that? Yes. If we sustain those levels, I think we will. Do we see an improvement in home buying? Do we see more activity? I think so. And given the fact that inventory, it depends on where you are, of course. Every market's different. So we can't go through the 4,400 zip codes across the US individually today. So on a national level, while there are going to be differences in different areas and markets, of course, on a national level, you should see good price appreciation. And let's say 3-4% in that range. Now, somebody might say, Barry, 3-4%, that's not so exciting. It is, because when you consider the beauty of leverage, and this is where real estate has created wealth. It is, the net worth of a home buyer is 44 times that of a renter. 44. We got that one right. Just remember. And also, if you look at all the net worth in the United States, 2/3 of it is in home equity. So it's an enormous wealth creator that people need to understand. Leverage. Why is leverage so important? Because unlike a stock, which you could put leverage on, and leverage just means you could borrow against it. So if you bought a home and you put 10% down, you're borrowing 90%. So you have a payment to make. But if you didn't buy a home, if you rented, you'd still have a payment to make. See, that's the thing, is you have to live somewhere. So the mortgage, you're making the payment on a payment you'd have to make anyway, whether it's renting or owning. And of course, over time, they might work out the same, a little bit more, a little less. But the idea is you got to make a payment somewhere to live. If you got, let's take an example. This is easy. $100,000 home. You put 10% down. Your investment is $10,000. That's the investment that you're making. If that home were to rise 3%, so the home goes from $100,000 to $103,000, you made a $3,000 profit. But the profit on your investment of $10,000 means you made $3,000 on a $10,000 investment, or a 30% rate of return. That's why you create wealth through real estate.
No, that's brilliant. And thank you for those insights. I feel that I could have a 4-hour podcast with you, Barry, to really drill down deeply into all of these things. But I do want to touch upon insurance, because we're seeing insurers leave Florida, California, and parts of Texas. Could the insurance crisis, not the interest rate, become the next housing crisis in America?
Boy, you really hope it would not. And I do believe that you have hit on a very important topic, because mortgage is an important and large component of the monthly payment. But there are other things. Taxes play a big role. And even in Florida, there is talk of maybe reducing, or potentially, you could eliminate all of it, but reducing significantly the portion of real estate taxes. That would be a huge plus, make Florida much more affordable, but not an easy thing to do. Insurance. Now, if I were to say, I don't typically love government intervention, but if I were to say, what is an area that the government can really make a difference and help? It would be in figuring out a way to ease the burden on insurance. If government could do that, then you could significantly reduce the barrier to entry, significantly reduce the burden, make homes much more affordable in a very rapid fashion. So I think you've hit on something that's brilliant. The other is, cost for title. Anybody who's been around the block, an attorney, a mortgage professional, a realtor, you ask them, when was the last time you saw a claim on title? In today's day and age, and let's remember that oftentimes, what I'm told, is the commission on a title policy is 90% of the policy. And the states kind of mandate how much it is. So there's not a negotiation there. I think that there could be some relief for many homeowners on the cost to buy if title were somewhat eased, the cost of it. And then I feel that insurance is another area which you very astutely have called out, especially in areas where the flood insurance or natural disasters cause it to be pretty dear in the amount that it takes, even if you can get it sometimes. It's a very, very important topic that you bring up. This is an area that I believe government could potentially help, because it is an emergency situation almost to alleviate this and help home ownership.
No, it is indeed. And if you were to deploy 100 million over the next 36 months, where would you put it?
Boy, that would be a lot of fun, wouldn't it?
It would indeed.
I don't know that I'm the best person to answer that.
Okay.
Because there are so many areas, and it isn't something that I'd want to do the proper research to give that the respect that it would need, because it can impact so many ways. But again, I'm always looking at things to try and say, look, we know it's a Rubik's Cube, right? It's not that easy. If you did this, what would the result of that be? And what could be the unintended consequences? So it's something I think that would need to be, had we been given that luxury, deeply thought out before deploying funds like that, and try and figure out the most beneficial way with the least amount of adverse consequences that are unforeseen.
Okay, no, I respect that answer. It was a very open-ended question, deliberately, just to bring out your thought process. But I do respect that, and it's true. You need to give $100 million the true respect it needs before you throw it at the wall. That's for sure. Going to New York, Mayor Mamdani, if he gave you 10 minutes, what data would shock him the most about the long-term effects of these policies that he's looking to bring in?
Well, it really wouldn't take a long time. Just look at anywhere in the world and just point to one instance where socialism has worked. It has not. It's easy to get votes by promising free stuff, and people go for it. People buy into it because it sounds nice. But it has been proven through history. It just doesn't work. And you can't keep promising things. Even rent control sounds awfully nice, but then things are expensive. And you're going to neglect properties if they're subject to rent control. You can't really sell a property that's subject to rent control or rent freezes or reduction in rents. It's a depreciating asset because the way that it works. I mean, think about any business. If you're going to sell a business, you don't just sell it for what it is today. You sell it for the growth potential. And you might do, here's a multiple of earnings, here's a multiple of revenue. Take a look at the stock market. The stock market is based so much in its performance on price to earnings ratio. And the price to earnings ratio might be X, but if growth is declining, that stock's going to do terrible. Think about a stock that said, hey, we had great earnings, but forward guidance doesn't look too good. The earnings should be great, but the stock's going, down. It's the same thing with values of properties. So while it would hurt those who currently hold properties, we have to think again into the future. What would be the incentive for people to buy? What would be the incentive to come into New York? And then the other one that I worry about is, there's been a lot of talk, and I don't know what he's going to do about either not being so supportive of the law enforcement, but also extraordinarily lenient on crimes. A lot of people don't want that. A lot of people want to feel safe. And, it's one thing to lose money. And that's not a good thing. And people will be hesitant, but it's another thing to be in fear for your safety. And look, I don't know which way it's going to go, but the talk is that these things are, leniency to criminals, less law enforcement. I don't know if people are excited about that. Well, I tell you, who would be excited about it is perhaps those who would benefit from that.
Yeah. And as somebody who's stepping into the real estate investing, primarily the fund side of it, I mean, what are the structural blind spots in affordable housing that even the experienced operators miss?
In affordable housing or real estate investing in general?
No, in affordable housing.
So I just want to understand the question better. So just kind of help flesh that out a
little
bit. Sure.
By affordable housing, I mean like Section 8 housing.
Rent, and investing in that type of environment?
Yes.
What you're ultimately hoping for as you make these investments as an investor, it's how am I going to make money? So am I buying this for the tax benefit? Maybe. Am I buying it for the depreciation, which the One Big Beautiful Bill Act might help with, the accelerated depreciation? That might solve a need if I have a big tax liability. Maybe that's a good thing. But I think most people are thinking about how am I going to either make money from a cash flow perspective or from an exit perspective. And if you're going to have a situation where those rents aren't going to be increasing over time, seeing a growth in cash flow because your expenses are going to increase. And if you're not being profitable and you're shelling out of your pocket, you're either going to neglect the property or try and sell it, but then who else is going to purchase it? So that's also going to be a situation that makes it difficult to make capital appreciation. So, I know that rising prices, people think it's bad, but modestly rising prices actually have an effect that can be beneficial over time, much better than declining prices.
I see. Because I was thinking there's an angle to this, buying 50 to 300 multifamily units or apartment units where the rent's guaranteed. by the government, right, under the Section 8 program. And yes, of course, through a fund structure to grow that side of the portfolio to be able to,
I see what you're saying now. Okay. Well, look, each situation has to be evaluated,
Sure.
right? So to blanket say it's either a good investment, bad investment, what's the angle? What is the individual purchaser's objectives? And then what is the specifics of, at the time, the interest rate environment, the rent, cash flow? What is the appreciation expectation for that marketplace? There is so much to consider. It could be very, very lucrative, but it could also be very tricky. And all those things have to be examined. I think it's very hard to just say it's a good idea or not a good idea across the board. I believe that, and I apologize now that I understand exactly what you're driving at. I think it has to be examined on a case-by-case basis with all of the facts and all of the potential forecasts that you could do.
That's a brilliant answer. And I could see you managing risk as we're on this podcast, which is...
Yeah, you have to try to be, you want to be thoughtful,
of course.
I think.
I respect that.
You do. You want to be thoughtful because there's more to one just side of it. And if we're going to be having a discussion that people may be making a decision to do something, we want to be careful and not cavalier, right? Because this is real important decisions that people could potentially be making. So therefore, we want to be thoughtful about that and do our best to first do no harm, and then hopefully help people make informed decisions that create positive outcome.
No, of course. And that's clear about you. I mean, the more I've understood about your background and read about it, it's very clear. You approach things from a very logical and grounded perspective rather than just throwing any form of information out there and numbers. So no, I totally agree with you. And you've built companies, you've forecasted markets, you've also influenced policy at the same time, and you're fighting cancer. So, I mean, what has that battle taught you about time, fear, and what actually matters?
Well, it reinforced a lot of the things that I've always done. One of the things that has gotten me through this is I've always lived my life from a perspective of gratitude. I've always appreciated, even though I came from extraordinarily difficult and humble beginnings, I try to always be happy. And I think that that's a decision that we make. We could either be miserable for the things we don't have or happy and appreciate the things we do. And in life, isn't really what we want to be is happy. So I made a decision with once this whole journey started. Of course, it's difficult, but that I was going to do the best I can to be able to enjoy every day instead of being miserable about it. I want to get the most out of every day, and however many days God gives me, I want to try and be positive and enjoy them. And I start every day with gratitude. Literally, I've done this for a long time. So this has helped me after the diagnosis. And it has helped. I've kept a really positive mindset. I've worked throughout, and there's been so much heartache too, because the first diagnosis was tough. And then several surgeries through the diagnosis, always bad news, bad news, bad news, bad news. And then I went through an extraordinarily rigorous chemo program. It's called EPOCH-R. I had to literally have a bag with a pump and a bag of different chemos that I had to have connected to the port here 24/7, 5 days, every 3 weeks. So you have it 5 days, you get 3 weeks later, again, 5 days, 6 rounds of that. And it takes a really tremendous toll on you. And then all to find out that it didn't work. Heartbreaking. So you have to pull on a lot of strength. And then I went through radiation, and then radiation led to something called CAR-T, which I was really excited about. We found out that didn't work. So much heartache. But I've gotten this new treatment that has put me in remission, which is great. Now, you celebrate quietly because this is a nasty kind of cancer that could come back, but you want to try and keep the remission as long as possible and as deep as possible. So I'm very happy and grateful, and I feel good. But I'm also just so thankful to God for the fact that I was able to get in touch with some extraordinary doctors that put me on clinical trials for things that have worked. I've got one in the Karolinska Institute in Sweden, just really truly by God's hand. And then one in California that's very famous. So I've got these famous doctors that are looking out for me. And then the Sloan in New York that I go to as well. So very competent people that have eyes on me. It allows me, they have differing opinions a lot, but it allows me to take everything in, make decisions. But to answer your question in a very long way, like I did with a little bit of background, there's two real important things here. One, control what you can control. Your mindset's critical. Enjoy the time you have. Appreciate it. don't take it for granted, even if you have adversity, because all of us have adversity. So the best way to get through it is with gratitude and appreciation. And secondarily, whatever your adversary is, for me, cancer, other things, become extraordinarily educated. I have spent maybe hundreds of hours with ChatGPT or speaking to doctors. When I talk to a physician, they ask me if I'm a doctor, because I will be able to rattle off everything. And a lot of times I will give them things that they didn't think about either. And it has helped me. And you know what? They enjoy talking to me a lot more because I'm someone who's really, and they all tell me you're probably the most educated patient we've ever had. But it shouldn't just be me. It should be everyone. The tools are there. Make the effort to, whatever your adversary is, be as educated as you can, so you can make the best decisions to guide you through it.
That's very powerful. And thank you for sharing that. That is very, very powerful. I'm sure there's other people going through their own processes and trials and tribulations, and that will benefit them as well. But you're definitely in our prayers at the same time.
Thank you.
And I would like to finish off by, finish this sentence, Barry. The next 10 years will be the greatest opportunity of our lifetime for people who
are optimistic. If you're optimistic and if you have gratitude, see, there's a secret. There's a secret to being magnetic. There's a secret to being attractive. And that is, everyone you come into contact with, try and make them feel smarter and better. So you can't do that by BSing them. Look for the good and have your own knowledge base and research so that you may be able to assist others and provide help to others. If you do that, people will be very attracted to you. And if you are in a state of gratitude and positivity, you will be able to see opportunities. If you think about it, there has been no shortage for any of us of opportunity. The problem is that we oftentimes didn't see it, or we saw it and we just couldn't deal with it and we missed it. You see, that's because if you're in a pissed off mindset, first of all, people don't want to be around you. So it's not good for your attractiveness or magnetism. Secondly, if you're in a pissed off mindset, you're not going to see opportunities because you're pissed. And third is you are not going to be able to, even if you see it, want to or correctly analyze the opportunity. So that's why I started with the word optimistic, but it's really gratitude and optimism and truly it's mindset. If your mindset is one of gratitude, optimism, positivity, you will be able to see opportunities, and therefore any period of time, the next year, the next 10 years, the next 20, whatever it is, through anything, you should find it to be extraordinarily beneficial.
That's very powerful words. Thank you so much for that, Barry.
My pleasure.